I've had a little bit of a drizzle out here all morning, and I gave these animals just about a half a load of feed. I gave them about a half a serving of feed, and I figured I would get back out here in about maybe 3-4 hours, and then I'd feed them again because I don't want the feed turning into some kind of a nasty soup. I don't want it getting all wet and then it turning into like a nasty feed soup. So I got them on a little bit of feed right now, and I've been taking a look at, yesterday I was talking about this whole idea about the P&E ratio of a company, and I got that jumbled up with the Warren Buffett indicator. I was taking a look at all these different things, and well, I mean, I would anticipate that here in about I don't really have I'm not really going to be in a situation where I need to start dumping money into different, because I don't, who knows, right? I mean, the whole thing about, I'll talk about my situation right now. What do I see? What am I looking at? I would say that if within 4 months I'm not able to find myself a new piece of land, I am actually, if I'm in a situation where I cannot find myself a new piece of land within 4 months, which I don't think is going to happen. I think it's going to, I think it's going to go okay, and I'll find myself something. And but if I'm not able to do that, I would actually rather hold on to the S&P 500 and Coca-Cola stock. And I've been talking about Coca-Cola stock, right? And but the whole idea of the P&E ratio is that it's the stock price divided by the earnings per share. That's what the P&E ratio is. And the Warren Buffett indicator is the market cap divided by the GDP. So the total market cap divided by the GDP. So I got those things jumbled up, and but the P&E ratio of Coca-Cola right now is sitting at about 25.5, 26. I think that they're actually going to do better this year than they did last year. Coca-Cola, it's got a 3% dividend. I mean, it's got a long track history of doing about 10% a year for a very long time. It provides a 3% dividend. If the price of the stock fell by half tomorrow, which it wouldn't, I mean, another way to look at that would be like, do you really think that a can of Coca-Cola is going to sell for 50 cents? Like, do you really think that that's how bad the economy is going to go? I don't think that the economy is going to go that bad. I actually think if something like that were to happen, the economy would actually go the other way. Coca-Cola would probably go to $1.50 before it went to 50 cents. All right, and that's the big idea of Coca-Cola. I've been talking about Coca-Cola as a fundamental company, right? In terms of a business, I mean, we take a look at Coca-Cola. They're effectively taking a can or a plastic bottle. They're putting a little bit of water in it and a little bit of syrup, and then they're selling it, right? And then they're making their money on that product. If in a worst case scenario, they were like, we're not making our margins or whatever, and the economy, whatever, the economy's bad and there's inflation, whatever, then Coca-Cola could actually raise the price of their product and people would still buy it. If Coca-Cola went from selling for $1 a can to $1.25 a can, people would still buy it. I guarantee it. People are not going to be like, oh my God, 25 cents, now I need to stop drinking Coca-Cola. I guarantee it. The restaurants across the world, they're not going to be like, oh my God, now it's time to get rid of my Coca-Cola machine. They're charging me 25 cents more. They're not going to do that. They'll just raise the price, right? That's the big idea of Coca-Cola, right? In terms of the product that they produce, it's a good product. If you take a look at it in terms of a fundamental business, they're taking effectively a plastic bottle or a can, and they're putting a little bit of water in it. They're putting a little bit of syrup in it, and then they're selling it, and then they're making money on it, right? I mean, and they provide a 3% dividend. I actually don't think that Coca-Cola is going to go bankrupt anytime soon. I don't, I drink Diet Coke, and and I don't see Coca-Cola going bankrupt anytime soon. There is, and I don't see the possibility of everybody just not drinking Coca-Cola tomorrow. Oh my God, I just don't want to drink Coca-Cola anymore. Right? All of the restaurants have gotten rid of their Coca-Cola machines. Right? And I don't see Coca-Cola going bankrupt. Okay. And they provide a 3% dividend. If Coca-Cola didn't go up at all, if you bought Coca-Cola at the very top of the market at $62 a share or whatever, if you bought Coca-Cola at the very top of the market and it fell 50% and it fell to $30, and you just completely stopped buying when the price of the stock fell. If the price of the stock fell, I mean, the P&E ratio of Coca-Cola right now is like 26, and I actually think that they're going to do better this year than they did last year. All right, and if you think about it, I think that, if the P&E ratio for last year was 26, or for, right now it's 26, and they're actually going to do better than they did, they're going to do better this year than they did last year, and they're selling, their stock is selling for $62, and the P&E ratio drops from 26 to 22 or 23, and let's say that the stock goes up, to about a 25 times multiple, right? Then we're effectively talking about Coca-Cola selling for about $68 a share. I think that Coca-Cola, if Coca-Cola started going to about $68 a share, actually not even the stock price, if the Coca-Cola, if their P&E ratio went up to about 27, 28, I would take a look at it again. I would stop buying it. All right, me, I'm not gonna have a situation. But here's the thing about my whole business. In terms of what do I see when I take a look at my business? I've been talking about leverage and cash flow and assets and tax deductions and all of these different things when it comes to the balance sheet, right? And the big idea is that I got cash, right? And do I have to use cash for everything? No, there are different ways to have access to money. You don't need cash, okay? I mean, cash is one way to have money, but it is also the most ridiculous way to have money. If you have $100,000 cash and you hold on to that $100,000 cash, if you make $100,000 for the year and you hold on to that $100,000 cash, by the end of the year, you will have to pay like $25,000, $30,000 in taxes. But if you go and you find yourself a tax deductible asset that is producing you a positive return, now not only do you not have to pay that tax, legally you do not have to pay that tax anymore, but you can also appreciate the value of the asset. You can actually make the money grow as well. So you're getting a benefit on both sides of the equation. You're not getting taxed. You're legally not getting taxed. I'm not talking about tax evasion. Tax evasion is not a good thing. And if you're thinking about evading your taxes, that's not a good thing. All right, tax evasion is not a good thing. I mean, it's that's not a good thing. I'm talking about legal tax deductions. All right, I'm not talking about tax evasion. If you buy assets for a business and those assets are tax deductible, legally tax deductible, you can reduce your income tax burdens. And if you are in a situation where you can increase the value of that asset profitably, now you can actually grow your money tax-free, and you can grow your money tax-free. All right, and you can realize your gains whenever you want. You can make as much money as you want. I call it printing my own money. All right, and the whole thing about well, I'm not going to be okay, but let me talk about my business, because let's say I go to the bank right now and I say, well, I got these 33 animals, but when I sell these 33 animals, I believe that I can make enough money to buy 58 animals. But when I take a look at the overall state of my herd, I'm going to be in a situation where I am meeting one of the two criteria required for liquidating animals, and that is, right, I mean, they are going to be at a weight range where the animal cannot be appreciated profitably anymore. Right, I've always said that there are two reasons for me to liquidate an asset almost all the time. One of these two requirements will have to be met almost all the time. Granted that I'm not in some desperate situation, but I've always said you don't want to be in a desperate situation with money. If you're in a desperate situation with money, there's a fundamental problem, and more money is not going to solve your problem. I mean, you're having a fundamental issue that is causing that problem, and money is not going to solve your problem. So what are we looking at, right? I mean, I said the two reasons why I would liquidate an asset is, number one, I do not have the capacity to appreciate the value of that asset profitably anymore. And number two, I actually just need some cash. Right? Am I desperate for cash? No, I'm not desperate for cash, but I just need some cash. Then I will liquidate the animal. All right, and when I liquidate the animal, I'm not going to liquidate all of my animals at the same time. I'm going to liquidate the least profitable animals first, right? These animals have the least margin to be made. I've already made the most amount of money, effectively about the most amount of money that I can on them. So I'm going to go ahead and liquidate those. I still have animals left over. And when let's say I take a look at my herd and I say, I got 27 animals left. I had 33 animals, but now I have 27. And I still think that my 27 animals are worth 48 animals. And I'm sitting here with whatever, right? I mean, $10,000, $11,000 cash. Right, and so I take a look at my scenario and I say, well, I want to hold on to my cash. I just want to hold on to some cash. I just want to hold on to it. I don't know, but I just want to hold on to it. Well, then I can take a loan against my herd. And if I take a loan against my herd, against the equitable evaluation of my herd, I would just be at zero. I will, granted that I took a loan for the entire amount. Right, and am I going to take a loan for the entire amount? No, I'm not. why would I do that? I don't, why would I do that? If I had the facilities to do that, sure I would. Right? Like if I said, I'm taking a look at my situation and I actually have the facilities and everything that I could actually go and bring home 40 animals tomorrow. If I had a facility like that, sure, I would bring home 40 animals tomorrow. Why not? Am I going to do that on my 10.5 acre field? No, I'm not going to do that. Okay. I'm not going to go into, leverage, every dollar that I have. And, I'm not going to do that. All right. But if I had the facilities to do it, would I do it? Sure, I would. Why not? Right. And so, we take a look at the situation and I say, well, I have money over here. And this is also what I mean by what? Cash is not the only way to have money. Right? If you see cash as money, you're probably poor. If cash is the only way that you see money, you're probably poor. Right? And if you want, and actually I wanted to talk about this too. Because a lot of times, like when you're looking at my situation and you're looking at me and you're saying, oh my God, I want to do this too. If you actually wanted to do this, the $5,000 a month that you need to actually do this is not what's stopping you. I guarantee it. I would be willing to bet 1,000 to 1. My 1,000 to your 1. The $5,000 that you need to go and buy yourself is not even going to be but if you're talking about actually covering your living expenses and everything too, right? Like you want to actually, not starve to death and you want to have a roof over your head. We're talking about to actually do this, you need about $5,000 a month. You go and get yourself a piece of land. You can even rent it if you have to. You go and you take a loan for, 20 animals, right? You go and you buy yourself, $1,000 worth of fertilizer. And then you go and you buy yourself whatever, $2,000 worth of feed, right? And then you're good to go effectively for the next foreseeable future. If you invested $5,000 a month, you could easily do this and still have enough money to actually just, live life, right? You're going to have a roof over your head and you're going to have food on your table and you're going to pay for your bills. $5,000 is what would do that. Is $5,000 actually what is stopping people from being able to do this? No, it's not. What's actually stopping people from being able to do this? The sheer difficulty of the work. You're going to have to learn how to run cattle. You're going to have to learn how to run a business. You're going to have to learn how to grow grass. You're going to have to learn how to do all of these things at the same time. And wherever you fail is where you're going to lose all your money. You're going to hemorrhage money. That's the difficult part. Actually learning how to farm. Actually learning how to run cattle. Actually learning how to run a business. That's the hard part. The $5,000 a month is not what's stopping anybody. Right? And this is why I put, and it's like if you actually want to, I was talking about this yesterday, right? But at about $5,000 a month, you can effectively, make a comfortable living. Like if you wanted to buy yourself a house and you wanted to buy yourself a car and you wanted to pay for your bills, if you brought home $5,000 a month, you could effectively do that. All right, at about $10,000 a month, now we're talking about if you bring home $10,000 a month and, even at $10,000 a month, granted that you don't go and be an idiot, right? You can effectively more or less do anything. Let's say you live on $7,000 a month and you invest $3,000 a month. Well, after 5-10 years, you will have enough money to do effectively anything on the entire planet. Right? Once you start bringing home $15,000 a month and you're also not an idiot, you can effectively do anything on the entire planet. Anything. You don't need $1 million. You don't need $10 million. You just need $15,000 a month. And I'm not saying just because, we're talking, even $15,000 a month. Most people can't, but and I talk about this all the time, in terms of money. If, you're probably a majority of people are not going to be able to work themselves to a point where they make $10,000 a month, $15,000 a month. And I know that that's kind of ironic because, it's like me, I work by myself, right? I actually work myself and I actually make about $25,000. I know that that's kind of ironic, right? It's like, I'm actually doing it and I'm telling you that most people will not do it. Like if you actually look at my situation and you're like, oh man, here's a guy, And I know, but when I actually take a look at my finances, and this is going to blow your mind, and I talk about this all the time, but, me, on the average, I make about $1,000 an hour, 24 hours a day, 365 days a year. You know, and it's like, you probably do not understand, you know, and how do I do that? I run my own business. My business is equitable. My business effectively revolves around the investment of equitable assets, and I own land as well. Right, I can go and I can realize, I can go into, you know, if I need more cash or whatever, I can just go and get it. Right, I just liquidate some of my assets. All right, you know, if you actually take a look at my finances, I make about $1,000 an hour, 24 hours a day, 365 days a year. If I went and I took $500,000, if I took $500,000 and I dug it in a hole, and if I dug a hole in the ground and I put that $500,000 in that hole and I lit that $500,000 on fire, it wouldn't even do anything to my finances. It wouldn't even dent my financials. All right, and you know, that's my situation. All right, and I know that it's kind of ironic, because it's like, oh, you know, why is he, you know, and well, you know, you can't work, or you can't really, a majority of people are not willing to work to a point where they make $15,000 an hour, or not $15,000 an hour, $15,000 a month. Most people are not. All right, I'm a very, you know, and I know that this sounds arrogant or whatever, but it just is what it is, okay? I mean, let's just take a look at it for what it is. It just is what it is. All right, I'm one of the very, very, very few exceptions. All right, it took me almost, you know, I didn't even get paid until I was 32. All right, I didn't even get paid until I was 31, but I still stuck to it. All right, we take a look at my situation, and we're like, you know, here is a guy, you know, and but it just is, you know, but if you want to take a look at a situation where, you know, if you want to look at somebody who actually brings home $25,000 cash every month, then sure, I mean, you can use me as an example. But most people are not willing to do that. And I talk about this in terms of a reality situation. When you take a look at me, we're talking about a 0.000001% success rate. There's a reason why that number is so low. And you don't need to make this much money to effectively be able to do anything that you want. You don't. And this is the thing that I think most people, you know, it's like a, you know, if you even made $15,000 a month, you could do anything that you wanted, granted that you were not an idiot. You want to live in a nice house and drive a G-Wagon, then you can do that on $15,000 a month, and you will still have $5,000 a month left over. You could put that into your investments, and if you do that for 10 years, you effectively have enough money to do anything on the entire planet. Short of like drugs, alcohol, buying a private jet, right? I mean, short of anything like that, short of being an idiot, you can do anything on the entire planet. All right, and it's like, if you want to raise your income, what is the most realistic way to do it? To learn how to invest. If you really want to raise your income, I mean, you know, or I mean, you can go and find a different job, right? You can go and find different work. You know, working more hours at your job is probably not going to save you. You know, it's probably not. I mean, you can go and find a different job, and that job could pay you more money. Maybe you could go and, you know, you can go and get a license, and some kind of a license, some kind of a certificate, and then you can get a better paying job. Right, but realistically, we're talking about investing. If you want to increase your income, the most realistic way to do it is to invest money. That's the most realistic way. I mean, if we're going to talk about, you know, like you want to raise your income to $10,000 a month, $15,000 a month, if you're making $3,000 a month, it's not hard to go to $5,000. If you're making $3,000 a month and you're expecting to go to $15,000 a month tomorrow, it's not going to happen. Probably not. I mean, you know, and, you know, it's just not. More than likely, it's not. All right, and, you know, and so, I mean, if you're making $3,000 a month, it's not hard to, you know, if you really put yourself to it, and you're like, you know, I'm really going to commit myself to this idea, and I'm going to go and find a way to make an extra $2,000 a month. And when I make that extra $2,000 a month, I'm not going to throw some sob story pity party for myself and go and buy myself a new car and, right, and, you know, I'm going to put that money into an investment. I'm going to take that money and I'm going to put it into this equitable asset, because I believe that this is a good asset and it's going to knowledgeably appreciate over the long term. I have a realistic idea for why that's going to happen. and then you put your money in that asset, within 5 years, I mean, you would have, I mean, you would be making an extra whatever just off of your investment. If things kind of went okay, you would be making an extra $25,000 a year on your investment, right? And now, now you don't have to work for the money. The money is now working for you. Right, and then you hold on to it for another 5 years, and now you're in a situation where you're actually, if you made the same amount of money, right? You went from making $3,000 a month to making $5,000 a month, and you made the same amount of money for the next 5 years, which is not good, but for the next 10 years, which is not good. But if you actually did that, and then now you're in a situation where you're at a situation where you're making about $10,000 a month. All right, if and so that's what we're realistically talking about, right? I mean, it's not going to happen overnight. All right, it's not going to happen overnight, and you have to commit yourself to the idea of, but okay, but if I'm going to talk about my situation, I'm going to be honest. Like me, me when I was 18 years old, I wasn't sitting there thinking, in 10 years I want to be a multi-millionaire. I wasn't thinking that. When I was, but the thing is like I think that you hit the age of reason, right? You hit the age of reason, and eventually you can actually get to a point where you're like, I've actually reasoned with myself, and I want to see myself do better. And even if it's hard for the next 10 years, then after that I can effectively do anything that I want, anything. Right? I mean, you want to get yourself, but but I'm going to be completely honest. Me, when I was 18, I wasn't sitting there going, when I'm 32, I want to run a multi-million-dollar farm. I wasn't thinking like that. Me, actually, but you know what I was thinking about? I was thinking about practicing. I wanted to learn how to do this thing. That's what if I'm just going to be completely honest, I was like, I want to learn how to grow crop. That's what I was thinking. All right, I want to learn how to do this thing, and I'm going to do it no matter what, even if it's just in a backyard with $100 worth of gardening equipment. Right, that was my situation. When I was 18, I wasn't thinking about I want to be a multi-millionaire farmer when I'm 30. I wasn't thinking about that. I was thinking about, I'm going to practice no matter what. I'm going to learn how to do this thing. Even if I only have $100 and I'm in just my backyard, right? And I went and bought a $20 worth of potting soil. I went and bought $30 worth of potting soil. I reused that potting soil every single year. And then I went and I bought about $50 worth of different fertilizers. And then that's how I learned how to grow crop. Right, and that's how that's what I was doing. So and this is something it's like you got to practice. I mean, that's also why I say things like, if you really want to learn how to do this, you have to practice. Practice is the most important thing. All right, you're not going to be able to do it tomorrow. You're not going to be able to do it next year. I mean, the success rate for this is borderline 0%. I mean, we're talking about 0.000001%. All right, and chances are, and if you think I'm wrong about it, then go and prove me wrong, okay? I mean, have fun, money talks. I mean, it just is what it is. Honest to God, God knows it. God knows it. It just is what it is. I could put $500,000 in a hole right now, and I could light that $500,000 on fire, and it wouldn't even faze me. Honest to God. All right, I'm being completely serious about it. All right, and that's why I talk about things like equitable investments. Right? Why do you want to have equitable investments? Because when you have an equitable investment, that investment is just as good as cash itself. The equitable evaluation of the asset is a cash value of the asset. So if you go into the bank and you say, I run this business right now, and I would say that my income is somewhere around $25,000 a month. Right, my business produces me about $15,000-$20,000 a month, and I live on about $5,000. I spend about $5,000, and in all honesty, I sit on about $15,000-$20,000 a month. I don't even spend it. There's nothing for me to buy. I don't really want to buy anything, but what I do actually want to buy is an opportunity to grow my business. And so now I'm sitting in the bank talking to the banker about it. then they'll say, how, what do you want, right? And then you'll say, I want to buy this piece of land, and then you show them your land, and it's, oh, well, this is another equitable asset. What are you going to do with this equitable asset? Well, I'm going to expand my business. I want to grow my business. Am I going to go and buy myself a Lamborghini? No, I'm not. Am I going to go and buy myself a G-Wagon? No, I'm not. Right? I want to grow my business. I don't really care, because at the end of the day, and I talk about this, but at the end of the day, it just is what it is, right? I mean, I know it just is what it is. I'm the one who knows how to make the money, and I'm the one with the money. I really do not give, it's like, oh my God, right? And I don't care for opinions. It just is what it is, okay? Money talks. I'm the one who knows how to make the money. I'm the one who makes the money. You think I don't really care for a worthless opinion. Oh my God, right? I don't. All right, I mean, it just is what it is. I mean, I don't know what else to tell you. It just is what it is. I'm the one who knows how to make the money, and I am the one who makes the money. And, and I show my business to, give people a realistic idea, right? Because I'm in a situation where, like, okay, so this video, I've been on this video for 26 minutes now, right? And I've been sitting here feeding my cattle, looking at my cattle. In these 26 minutes that I filmed my video, I made about $500. All right, I made about $500. It's different and this is what I'm telling you. If you find somebody who makes 400 or 500 times more money than the average person, their life is going to be different. Their life will be different. They will think about different things. Am I thinking about the world is oh my God, the world is unfair, and there are people out there who have 5,000 times more money than me, and that's not fair? No, I'm not thinking about that. Right? I mean, what am I thinking about? I want to grow my business. Right? Am I thinking, oh my God, I want a Lamborghini? No, I'm not thinking about stuff like that. What am I thinking about? I want to grow my business. How is my business doing right now? Where do I see my business going in 3 months? Where do I see my business going next year? Right? How much cash flow do I anticipate that I'm going to have? Those are the things that I think about. I don't think, oh my God, right? I think about things differently. And I'm telling you, if you took the average person and you multiplied but you're not going to be able to take the average person and multiply their income by 400, because even if you multiplied their income by plus 10%, they would ruin their financials. Most people would. And this is actually, this is something that I talk about, right? Under any there is legitimately zero circumstance. Even if I present a way, even if I show you that it's possible, that there's a way that you could there's a 98% success rate, and after a certain point the money's not even going to do anything. And I talk about all these different things, and I give you a logical way for me, how I think about things, right? This is a very logical way to think about things. If you make $15,000 a month take home pay, you live on $10,000 and you invest $5,000, and you're not an idiot. You effectively have enough money to do anything on the entire planet. When you're watching me and you're actually taking a look at what I'm doing, chances are you don't actually want to do this, because this is a 0.00001% success rate. What you actually probably want is $15,000 a month, $10,000 a month. That's probably what you actually want. Are you going to be able to do that overnight? No, you cannot. But once you hit that point, you learn a lot along the way, right? Because chances are, chances are, you probably do not, want to actually, and here's the thing, it's like, if we take a look at it for what it is, I actually don't know anybody that can even do 10% of what I do, not even 10%. All right, when you talk about farming like this, this is borderline impossible. The average person under any circumstance will not be able to do this. Granted that you're not like in a situation where you're like, I'm legitimately just going to give up everything, and I'm going to sit here and I'm going to work on this. I'm just going to focus on practice. Like, that's what I did when I was 18. I was focused on practicing. All right, I wasn't worried about, oh my God, I want to be a multi-millionaire farmer. I want to go and run a $5 million farm business tomorrow. I wasn't thinking like that. All right, and if you're sitting there and you're going, oh my God, I want to be a 1 in 8 billion type farmer too. right? Maybe there's 5 people on the entire planet that can farm like me. And it's like, I wasn't thinking something ridiculous like that. Oh my God, I want to go and run a $5 million farm tomorrow. Oh my God, I want to go and run a $5 million farm next year. I wasn't thinking like that. I was like, you know what? I'm going to figure this thing out, and I want to learn how to do this under any circumstance. All right, I had about $100. I bought about $20 worth of potting soil. I bought about maybe $70-$80 worth of fertilizer. And then, and then I just practiced with that for about 7 years. All right, and that's honest to God, that's what happened to me. I wasn't sitting there at 18 years old going, oh my God, I want to run a $5 million farm business. All right, I wasn't doing that. That's ridiculous. All right, but the big thing is that you have to get started. And I would actually say that the S&P 500 is a very, very, very realistic investment. It's like, you can get started in it, and but if you invest $2,000 a month into it, and because here's the thing, and let's say that you make $3,000 a month right now. And you find a way to increase your income to $5,000 a month. You went and got yourself a certificate. You went and got yourself a better job. You went and whatever it may be, you actually found a way to do it. All right, so you went and you found a way to do it, and then you started investing that $2,000 a month. And after 5 years, but okay, let's just not, because whatever, right? 5 years, because it's like, oh well, what if I have an emergency and I need the money? All right, let's say after after 1 year, you've put $24,000 into this thing, and the thing's made you about an extra $1,000 in interest, or it's grown by about $1,000, not interest, but the thing's grown by about $1,000. So now you have $25,000 worth of the S&P. And let's say that you feel like you need to have $10,000 on you just because you want to have access to $10,000. You don't want $10,000 cash, but you want access to 10 grand. Well, then you can go to the bank and open a line of credit for 10 grand. All right, you can go to the bank and open a line of credit for 10 grand. And you don't have to, and here's the thing about holding your assets collateral. You don't have to directly hold your assets as collateral. All right, and I'll use my cattle as an example. Let's say that I run this farm, and this farm makes me a whatever, right? And I would say that my cattle are in the net positive. I take a look at my herd and I determine that if I sell these animals, I can actually buy a net positive amount of animals. And so I go to the bank, and I don't want to collateralize my cattle for a line of credit, but I have my business, right? My business is equitable as well, just like the cattle and just like the land. So I go to the bank and I take a look at my herd, and I say, well, I believe that my herd, when I appraise the value of my herd, the herd is worth this much, and I owe this much money on them. So my net positive is whatever amount. I have a net positive amount on these animals. I don't have to ask the bank for a loan against my animals. I can take a loan against whatever equitable asset that I want. I can take a loan against my business and get a business line of credit. And let's say I go and I get a business line of credit, and the banker gives me whatever, 200 grand. The banker says, here you go, here's $200,000. So I'm sitting there with my $200,000, and let's say it's got 7.5% interest. So I'm sitting there with my line of credit, 7.5% interest, $200,000. I don't pay any interest on it unless I use it. I take a look at my herd and I say, well, I would anticipate that my herd is evaluated at this much money, and I owe this much money, so I have a net positive amount of this much money. My cash flow is going to be this amount over the next 6 months, over the next year, over the next foreseeable future. This is how much cash flow I'm going to produce. This is what my debt service is going to cost me. Then I can take a look at everything together, and then determine how much money do I want to use. And I don't have to collateralize my cattle for the line of credit. So let's say that you have, I can collateralize my business for a line of credit, and then I can just use the amount that I want to. And the amount that I want to use is going to be the net positive evaluation of my herd. So let's say that you have $25,000 in the S&P, and it's going to go up on the average 10% a year. All right, let's just say 10% a year on the average. So you have $25,000 in the S&P, and you decide for yourself, you know what, I wanna have 10 grand, because I believe that if I have 10 grand, that's just the amount of money that I want to hold on to, right? I want to have access to 10 grand because if I have access to 10 grand, then that's going to be a good amount of money, right? It would make it, you know, for whatever reason you decided that you want access to 10 grand. Should you go and buy yourself a whatever, right? Whatever with your 10, you'd probably not do that. Right? I mean, could you use your 10 grand as a down payment? Sure, you could for a house. Sure, you could do that. But I mean, houses are also not very good investments. All right, houses are equitable, but they do not produce you a positive return other than the appraisal value of the home. But here's the big problem that you run into, and I'll use a home as a good example. When you have something like a house, houses cost money. Things break, right? I mean, you decide that you want new furniture, right? You got to pay the bills. Houses cost money. They don't really, I mean, and if you want to access the equity of your home, you either have to do that via a line of credit or you have to sell the house itself. So homes are not that good of an investment. They're not. All right. I would actually say that the S&P 500 is a better investment than a home. In the S&P 500, from what I believe, the S&P 500 is a better investment than a house. All right. And so let's say that you have $25,000 worth of a stock. You have $25,000 worth of a stock of the S&P 500, and you want to go and you want to take a loan for a home, and you want to use $10,000 as the down payment. But your $10,000 down payment is going to be on a 30-year term. Your $10,000 down payment is going to be on a 30-year term, and it's going to be at whatever 7% interest. But you're holding on to $25,000 worth of stock that is going up by about 10% a year. The $2,500 that you produce from that $25,000 worth of investments will actually negate the effects of the $10,000 that you put as the down payment. All right, and so, it's effectively, now you're in a situation like, what I'm describing, right? Where you have to take a look at your balance sheet, and you have to determine for yourself, what do you believe is a reasonable amount of money that you should go and utilize? Should you leverage yourself to the eyeballs to go and, buy yourself worthless assets? No, you should not, okay? That's not a good idea. And the birds are pooping up in the thing. But, should you go and buy yourself a bunch of worthless assets? No, you should not, okay? I would highly suggest that you do not do that. What is in terms of the best assets is that you want a good asset. You don't, even if it's cheap, you don't want to buy a damaged asset for a cheap price. There's no reason to do that. You want to buy a good asset, and you also want an asset that is producing you a positive return. You want when you're looking for assets, you want to look for assets that have large amounts of equity involved in them. Businesses, land, stuff like that. I mean, commodities, the broader economy, the U.S. Treasury bond, something like that. All right, you want to buy something like that, and you want to hold on to the thing forever, and then you can use the return for and when you take a look at your situation and you're saying, I have this much of this asset, and I reasonably anticipate that it's going to go up by 10% a year. And, I have $25,000 in this asset, and I believe it's going to go up by 10%. But I want to utilize $10,000. Then you don't sell your asset. You go and you get a line of credit for that 10 grand. And if that 10 grand, if the cost for that 10 grand loan is going to be lower than the appreciation value of your asset, then it doesn't matter. All right, if you're in a situation where, let's say that the market's tanked 50%, you bought all of your stock at the very top, right? And something. I mean, this is how ridiculous this idea sounds. If you think that your stock portfolio is going to fall by 50%, let's say that you're buying a good asset. You're buying Coca-Cola, you're buying the S&P 500. You've actually, the S&P 500 would probably be a better example of a good asset for most people. Let's say that you're buying the S&P 500. If you legitimately think that your stock portfolio is going to fall by 50%, this is how ridiculous it's going to be. the overall US economy would have to fall by 50%. You would have had to buy all of your stock at the very top of the market. And when the market fell, you would have had to put $0 more into the market. That's how ridiculous that idea is. If you legitimately think that your S&P 500 investment is going to fall by 50%, that is how ridiculous of an idea we're talking about. You would have had to put all of your money in at the very top of the market. And when the market crashed, you would have put no more money into the market. And then the markets went sideways forever. That's how ridiculous of an idea we're talking about. And if the S&P 500 were going to fall that drastically, the interest rate would go to like 0%. Interest rates would be borderline negative. You could borrow money for free. So, that's how ridiculous of an idea we're talking about when we're saying, oh my God, what if I put money into the S&P 500 and my stock portfolio goes down by 50%? That's how ridiculous of an idea we're talking about. All right, the S&P 500, you would have had to put all of your money in at the very top. And then when the markets fell, but the US economy fell by half, 50% of everything is gone. The US economy tanked by 50%. Then you put no more money into the markets, and the stock market went sideways forever. That's how ridiculous of an idea we're talking about. And also the S&P, the SPY produces a yearly dividend of almost 2%. All right, so that's how ridiculous of an idea we're talking about. You're talking about the entire US economy falling by half, you buying all of the stock at the very top, not putting in any more money when the markets fell by half, and then the market's going sideways forever. That's the idea we're talking about. Is that going to happen? No, it's not. That's ridiculous. If something like that were going to happen in terms of a probability, there's more of a chance that it goes the other way. The markets crash vertically. Uncontrollable inflation. That's more realistic than the markets going down by half. You buying everything at the very top, not putting in any more money once the economy fell by half, and then the market's going sideways forever. There's a more realistic possibility that there is uncontrollable inflation before that happens. And even if that happens, if that were to happen, if the S&P 500 were legitimately to go to 50%, half of the US economy is gone, you could borrow money at borderline negative interest rates. If that were to happen. All right, so we got to consider it for what it is. All right, you don't want to put yourself in these ridiculous situations, right? Oh my God, I think that the economy is going to fall by half. Even if it falls by half, granted that you didn't buy all of your stocks at the very top and stopped buying your stocks at halfway, and then the markets went sideways forever, and the S&P, the SPY produced a 0% dividend. Granted that something like that is not going to happen. Just the dividend amount of the SPY, the 2% dividend would make that impossible. Just the 2% dividend. The SPY is guaranteed a 2% dividend, something like 2%. It's like 1.96% or something, 1.75% or something like that. So there is legitimately zero possibility of that happening. The dividend of the stock would have to go to zero. You would have had to buy all of your stock at the very top. The stock would have had, the US economy would have had to have been cut in half. And then the stock market would have had to gone sideways forever. That's not going to happen. All right, if you think that is going to happen, that's ridiculous. It's not going to happen. All right, and so, the S&P 500 is a very good investment. All right, and, you want equitable assets. All right, and I use my situation as an example. If we talk about land, if we talk about business, if we talk about cattle, let's talk about, whatever it may be, right? My land produces me about $20,000 a month. This business, I run this business on this piece of land. If I didn't have the land, I couldn't run the business. This land produces me about $20,000 a month net take-home pay. If I went to the bank right now and I said, you know what, banker, I make about a net excess income of about $15,000 a month. After I pay for all of my bills, after I pay for everything, I still have about $15,000 a month left over. And I have these equitable assets. I want you to give me some money. Why do I, just because I want some money, I'm not leveraging myself to the eyeballs. I just want to have some money so I can go and buy whatever. I just want to have some money. And how much money do you want? I want $500,000. Well, here you go. Here's a line of credit. We're going to hold, we're going to utilize your income to give you a loan for this amount. And then we're going to hold your, your land as collateral for this amount. And then we're going to give you the line of credit. And then if I went and I took the entire line of credit and I dug a hole in my backyard and I shoveled the money into the hole and I lit that money on fire, it wouldn't even be about 15% of my money. About 15%. How do you end up in that situation? You want equitable assets that are good equitable assets. You want them to be equitable. All right, if they are equitable and you are producing a positive return, you can float your debt by utilizing the asset itself. You can collateralize your asset. The asset is producing you a positive return. You can use that return to pay for the leverage. And when you're that's how you have access. That's how you make a boatload of money. And so why do I talk about things like the S&P 500? Because it's a good asset. It's a very realistic possibility of something going up by 10% forever. If you think about the S&P if you think about you losing half of your money in the S&P 500, that is how ridiculous of an idea it is. You would have to put all of your money in at the very top of the S&P 500. It would have had to gone to 50%. You would have had to completely stop putting money in the S&P 500 when it went to half. And then the dividend of the SPY would have had gone to 0%. The dividend of the S&P of the SPY is at about 1.752%. So the dividend is gone. You put all of your money in at the very top of the stock. The stock fell to 50%. The half of the U.S. economy evaporated into thin air, right? I mean, half of the U.S. economy evaporated. You put all of your money in at the very top. It went halfway. You didn't put any more money into the stock when the stock went to half. The dividend went to 0, and then the stock went sideways forever. That's how ridiculous of an idea it is to lose half of your money in the stock market. Granted that you're not gambling. If you're just purchasing good assets and you're holding on to those assets forever, and if you really want to, utilize some of your money, you can go and get a line of credit and then utilize the asset to float the debt. Granted that you're not leveraging yourself to the eyeballs. Now, then you can buy whatever the heck you want. I mean, and that's how I utilize money. I take a look at my situation and I say, well, my field is equitable, my business is equitable, my cattle are equitable. I produce a net positive income of about $15,000 a month. I'm net positive about $15,000 a month. I buy everything that I want, everything, and I still have about $15,000 a month left over, maybe even up to $20,000. So I go to the bank and I say, give me some money. I just want to have access to some money because I don't know, but I just want to have access to some money. They take a look at my situation and they say, okay, well, you're net positive $15,000 a month. You're net positive $20,000 a month. You have about $20,000 a month money left over, right? You own land, you own a business, and you own cattle. All of these are equitable assets. And I ask for something, a minuscule amount of money, like 500 grand. I just want 500 grand. And they give me the 500 grand. I take that 500 grand and I dig a hole in my backyard and I light it on fire. It would be 15% of my money. 15%. All right, that's why you want equitable assets. And if you have a good asset, I mean, there's no reason. I mean, it's ridiculous to think about your good asset going down to half price. And if the S&P 500 did go down to half price, if the S&P 500 legitimately fell 50%, the dividend went to 0, and the stock market went sideways forever, and you bought all of your stock at the very top, and when it fell 50%, you didn't buy any more. If that were to happen, which it's not going to happen, that's ridiculous. You could borrow money at borderline negative interest rates. That would mean that the economy is not growing at all. The economy fell 50%. You could borrow money at borderline negative interest rates if that were to happen, which it's not. All right, you know, the S&P 500, the SPY already produces a 1.752% dividend. There is no way that you're going to make a 0% return on your stock. There's no way. It's not possible. The dividend would have to go to zero. You would have had to buy everything at the very top and then buy nothing when it falls halfway. The economy would have had to gone sideways forever, and then the dividend would have had to go to 0% as well. All right, it's not possible. And if that were to happen, you could borrow money at negative interest rates. All right, so there's no reason to worry about that. If anything, you should be more worried about things crashing the other way, which I don't think is going to happen. I believe that, you know, more or less, we're just going to see about 2% inflation. Maybe it might be a little bit worse. It might be 2.5% for about the next 10 years. But, you know, more or less, it's more or less going to be the same thing. All right, you know, what do I realistically see happening over the near future, over the next 10 years? You're probably, you know, Coca-Cola going to go from $1 a can to $1.25 a can. All right, you know, your rent, if you're paying $1,500 a month for it right now, your rent is going to go up to about $2,000. All right, I mean, maybe we're talking about 2.5% inflation a year, 2% inflation a year, 2.5%. The bigger economic forces at hand are looking for 2%, but inflation is kind of out of control right now. Trump is really looking to get a handle on things, and that's good. I mean, if Trump puts himself to it, he'll probably do it. Right, you know, he'll probably do it. I mean, he's looking to get inflation under control, and you know, I think inflation is going to be about 2%, 2.5% for about the next 10 years. If you're paying $1,500 a month for rent right now, you're probably going to end up paying about $2,000 in 10 years. Coca-Cola about $1 a can. In about 10 years, it's going to be about $1.25. Something like that is going to happen. All right, is the economy going to, you know, are you going to end up buying stocks at the very top of the market? The market's going to fall 50%. You're not going to put any more money into the markets. The dividend is going to go to 0%, and then the stock market's going to go sideways forever. And, you know, no, I don't think that that's going to happen. All right, so you're better off investing your money, looking for a good asset, investing your money. And if you really need access to the money, take a look at your balance sheet, determine how much, how much money are you generating in unrealized gains, and et cetera, right? You're taking a look at your unrealized gain values, and you're roughly anticipating how much money are you going to make. Then you can take a, don't go and leverage yourself to the eyeballs. And, you can take a whatever, right? I mean, you can take a line of credit for whatever you believe is a reasonable amount of money. Should you go and buy yourself some ridiculous thing? Probably not. I mean, what's the best thing to buy? An equitable asset that produces a positive return. All right, more or less. All right, but that's it for me today, YouTube. Y'all have a good one.